that caused short sellers' trades to delay their execution by 5 milliseconds, would you think that that has a significant effect on corporate finance variables? Would you think that changes the likelihood that the CEO is going to build a new factory in Budapest or something like that? Probably not. So I think, if you really think about the economic mechanism, you wouldn't think that regulation SHO had that much of an effect. What might it change? Well, by basically what it did by taking short sales and turning them from market orders into non-marketable limit orders is it basically made short sellers become liquidity suppliers instead of liquidity demanders. And so then when you actually look at the variables that survived the Romano and Wolff correction, they're actually variables that make sense, right? That we actually think make sense given the mechanism. So bid-ask spreads, stock volatility, and things that are a function of order imbalance actually change. So I think that kind of makes sense. You actually see variables that you'd think should matter are the ones that actually survive. Now, I also want to point out that if you look at this list, one frightening thing is we don't talk about short selling yet. And so let me come back to the first order effects in just a bit. Okay, so then that's the first method. The first method, which uses the date of publication to sort these things, has this nice property of being objective, right? The researcher has no discretion in what to do. But when I've talked about this result to people before, a lot of us argue, well, hey, we're not statisticians, we're economists. We have an economic theory for believing certain effects. And you should treat things that have an economic theory behind them differently. And I have kind of two answers for that. So one, that's not what p-values do, right? So p-values are p-values. But I agree with the spirit of the comment that we should think about the economic mechanism. And so the second method that we're going to propose is what we'll call the causal chain method. What we're going to do is basically we're going to kind of think about the economic effects, and we're going to try to make an ordering of if this experiment mattered, what should be affected first? Well, that should be the first thing tested. What should be affected second? That should be the second thing tested, and so on and so forth. And we're going to use that causal chain ordering to develop the ordering for applying the Romano and Wolff method. So what we'll do then again is we'll set aside first order effects first, second order effects second, third order effects third, and I'll show you an example in just a second. And then what we're going to do is apply the Romano and Wolff bootstrap procedure, the step-down procedure, but we're going to do a loop based off of that kind of causal chain grouping of the variables. Right, so first iteration, you loop through all the papers that had first order effects. Second order effects come next, right? Third order effects come after that. And so let me give you an example of this. Now, when we do this causal chain ordering, there is necessarily some subjectivity. So on the benefit side, it allows us as economists to do more than just kind of look at stats. But of course, that also means there's some subjectivity to what we're doing. So for regulation SHO, you might say, hey, the first thing that should happen is it should change short selling. So you could look at variables like short interest and short selling. Those are the first order effects. If the experiment mattered, you'd expect those things to change. Conditional on those effects, you might start thinking about second order effects. So if it changes short selling behavior, you might expect that asset prices and liquidity and price efficiency and those types of things start changing. If those things change, then you might start thinking about third order effects. Things like managerial decisions might change. Managers might change their investment decisions, their payout decisions, etc. If that changes, then you could even think about external parties, auditors, bankers, suppliers, customers, that kind of stuff. But the idea here is, of course, there is some subjectivity, but it is try to order the variables by what you think is most likely to have an effect, and then use that to apply the Romano and Wolff procedure. Okay, so in the interest of time, I'm going to kind of skip over exactly the ordering we use, but let me talk a little bit about what happens. So when you apply this causal ordering, what you see again is you actually get similar results to what we had in the first method. So pretty quickly what you see is the critical value jumps up to about 3. Now notice here, I don't have number of papers on the horizontal axis in panel C. Instead, what I have is kind of this step in the causal chain. So there are first order effects, then second order effects, then third order effects, etc. But what you see is The p-value cutoff rapidly approaches 3, which actually looks pretty similar to the cutoff we saw in the previous result. And you get relatively similar results for both business combination laws and regulation SHO. So what does this change our inference? Well, it does. It turns out it changes the inference quite a bit. So what you see here is we have even fewer results that actually survive the Romano and Wolff correction. For business combination laws, there's an investment variable that's the only thing that survives. So we get only one variable that actually survives. For regulation SHO, PIN survives, stock volatility survives, and citation survive. Again, I would argue PIN and stock volatility kind of make sense. So it seems like we should expect maybe a few variables to survive in this setting, and they're the ones that actually make sense. Okay, so then the last method I want to talk about relates to some of the questions you guys have asked. So let me get through this one, and then I'll pause and take some more questions. So some of you kind of, again, talked about what is a family of tests? What variables should I use? Someone raised the issue of we as researchers don't even know what other variables people may have checked. So one thing we can do is we can just assume all variables that we know about, all variables that are in the literature were checked right away. And that's a relatively conservative way of actually applying this. So what we're going to do is we're just going to say, let's assume that the researchers sat down and they checked every variable that's published right away. And then we're going to apply the Romano and Wolff procedure to that entire set of variables. So what ends up happening? Well, it turns out again, even though this method I think is a little different than what we did before, the actual inference we get is basically identical to what we have. So it turns out regardless of kind of exactly how you apply the Romano and Wolff procedure, the good news I think is that you basically get the same conclusions. So again, we see STI, stock volatility, PIN are kind of the variables that actually survive the Romano and Wolff procedure. Okay, so what do I learn from all of this? Well, I think what this suggests is that many of the results in the existing literature are type 1 errors. So if we had accounted for multiple testing when these papers were written, we would have made different inferences. And now what I want to mention again is, in some sense, what I've shown you so far is a lower bound on the severity of this problem. So one, even this pooled method that I just talked about, which looked at all the published results at once, only looks at the published results. It may be the case that researchers even checked a bunch of variables that we didn't even see. So I'll talk about how we deal with that in just a second. But with that, I'll pause for a second and see if we have any questions.
Oh, we have tons of them. So
Excellent.
I'm going to read some of them, and if I don't, be sure that Matt is going to see them all because he's going to get the print out of the chat and be able to, address them in the subsequent revisions of the paper. So let me start. So the publication date method will create a land grab. Researchers have the incentive to include every variable possible to not be preempted by someone else. Why wouldn't be the threshold retroactive on the first variables tested?
I mean, that might be true, but I think you could argue that that's true already, right? People still have an incentive to be the first right now. I mean, the way I think about this is I showed you 3 different ways that you could apply the Romano and Wolff method. There's trade-offs with them. I think they have various strengths and weaknesses. In some sense, I like the economic causal chain method the best, but the problem is of course, I can't guarantee that everyone will use that in the correct method, right? So everyone might argue that their variable was the one that was motivated by economic theory. What's nice about date of publication is it's objective. We just look up the date that the papers came out and we can kind of get that ordering. But I agree, it's certainly not a perfect method. The good news is the results seem to be generally robust across the different choices.
Okay, so why should adjustment account for prior publications of working papers? Isn't the relevant comparison group the set of potential outcome variables? I guess you kind of addressed this in your second methodology.
But I do agree with that. And so in fact, what I'm gonna do next is so you can kind of view this as one extreme. I'm saying, imagine the only variables the profession checked are the ones that are published. There's another extreme, which is imagine the profession checked every single variable possible. And I'm going to do that next. That'll be the next section I come from. So of course, I can't tell you for any variable what is the exact truth, It's somewhere probably in the middle. But what we can do is check the extremes. And so then I think we'll have confidence that the truth lies somewhere in between those extremes.
Okay. You could have a spurious outcome variable on the very first paper that could have a false positive. What if there are a number of non-economical outcome variables before the real economic outcome? The bar shouldn't be higher.
Yeah, I mean, I think, you know, that's a case where you could then argue that the economic causal chain method should be used. So I think there is a little bit of discretion there, where if you can properly motivate the economics behind what you're doing, you can say, look, the first variable that we should expect is this one, and I'm going to treat that as the first result. So that's, I think, why we discuss that method. And again, I think we're kind of the first to show how to do that in the Romano and Wolf procedure. I probably didn't do it justice in this little talk, but in the paper, we talk about how you would precisely implement that method.
There are several questions which are related to the particular implementation of bootstrap procedure. I'm going to kind of defer them until probably later. So Matt, your graph suggests that the adjusted t-stat should be closer to 3 rather than 2. If you take t-stats from papers that use RegSHO rather than your application, how many of them have their main test t-stat larger than 3? Maybe multitasking is just a small part of what's going on here, and most of their t-stats are greater than 3.
So, I mean, that's certainly possible. Again, but I think, again, what we're showing here, let me say it actually in a slightly different way. One thing I really also want to be careful with is what one of my co-authors called the cult of p-values, right? We shouldn't treat p-values as some sort of ultimate answer, where if you're below some threshold, I believe the result, and if you're above some threshold, I don't believe the result, right? All we're saying here is that we need to be more careful when we're actually thinking about these natural experiments, when we're making inferences. To me, there are a ton of other issues with regulation SHO beyond just the multiple testing bias. So in fact, people have shown that it seems like the SEC had issues when they set up the experiment. There seems to be violations of the stable unit treatment value assumption. And moreover, it seems like most of the papers that have looked at it have found it didn't change short selling itself. So what I'm going to do at the end of this talk is try to provide some positive evidence for how I think we should use natural experiments. Multiple testing adjustments will be one of the key things, but we're also going to talk about some of these other issues. Like, I think it's really important that every single paper that uses a setting first verifies the first stage. Show us that short selling actually significantly changed. Show us that the probability of takeovers significantly changed. And so then we'll talk through some kind of the other things that I think researchers should do. But our broad point is not that you know, t-stats above X are correct and t-stats below X are not. It's that we need to be much more careful when we're making inferences with data.
In the interest of time, I'm going just to let Matt answer one more question now, and then we're going to defer the remaining questions till the end of the presentation. So if you can't replicate the statistical significance of individual results, it's not clear that the results should be reinterpreted given your correction. The black and gray bars are highly correlated across dependent variables in these figures.
I mean, they are highly correlated, but the Romano and Wolf procedure accounts for that. But what we're going to do next maybe will help a little bit with this issue. So what we're going to do next is I'm going to go to the other extreme. I'm going to say, let's assume the profession checked every single variable they could have. And there, I'm going to get a ton of things that are statistically significant. And then we can apply the testing correction and see what happens. And we'll see if it changes our inference. And you know, I'll give you guys the heads up. Maybe this is not surprising. It is going to change our inference. So maybe I'll jump in and I'll kind of show you a little bit about what we're going to do there. Okay, so let's go to the other extreme. Let's assume that there is this kind of latent issue where researchers have examined variables and we don't know about it. So what we're going to do is basically we're going to go to the other extreme and we're going to intentionally data mine. We are going to look at all variables that basically we could have looked at. So what we're going to do is for each of our settings, we're going to go to CompuStat and CRISP. And basically, we're going to just do some really simple variables. We're going to pull all variables that are basically non-missing the majority of the time. And we're going to compute a couple of different variations on these. So we'll take the raw variables. Sometimes we'll scale by assets. But what we're going to do is we're going to end up with basically a sample of 300 different dependent variables that the profession could have checked if they had wanted to. And then what we're going to do is we're going to reevaluate our settings and we're going to see what we get. And so here's the interesting thing. If you go to business combination laws and regulation SHO, you actually find a ton of things that are statistically significant before we do the multiple testing adjustment. So in panels A and B here, the kind of darker lines show you the raw p-values as we check different numbers of variables. And what you end up seeing here is the darker line crosses this red line here at about 60. So we end up with about 60 different things that are statistically significant for business combination laws. We end up with a little bit less than that. I think it's about 30 things that are statistically significant if we look at regulation SHO. The interesting thing is many of the variables that we find that are statistically significant are published in papers. So again, what does that mean? Well, I'm not saying that individual researchers sat down and checked every single variable in Crispin CompuStat. I actually don't believe most people do that. But I do think collectively as a profession, we may have accidentally done that. In fact, I find it remarkably coincidental that when we find 60 business combination laws variables that work, most of them show up in existing papers. That suggests that the profession collectively has looked at a lot of the variables that are out there. So then what do? Well, we apply the multiple testing correction. And what do you end up seeing? Well, basically very few variables end up surviving after you apply multiple testing corrections. So in fact, if you look at this, we have 66 that are statistically significant for business combination laws. Once you apply multiple testing corrections, you end up with 8. So that's a tiny fraction of the overall variables that work. For Reg Show, we have 24 that work. If you apply multiple testing across all of them, you end up with 0. So again, what does this tell you? Well, I don't know, as many of you raised, the exact set of variables that the profession actually looked at. But if you assume the profession checked all of them, which is maybe not an insane assumption, what you actually see then is you get a bunch of the variables in regular Diff-in-Diff regressions that look statistically significant. Many of those are in papers already. If you assume then that we should apply multiple testing to all of these, you find basically almost none of them survive. So again, I think, I don't think individual people have done this, but our profession has gotten so obsessed with using these shocks that basically as a profession, we've checked almost all the variables we can check. And I think that means we have a ton of type 1 errors out there. So my view is that most of the papers in this literature, unfortunately, are probably type 1 errors. In fact, one thing I should point out when we look at this data mining exercise is actually for regulation SHO, short selling and short interest are not statistically significant in our setting. So again, the first order effect doesn't seem to be there. When you look at business combination laws, there are already papers that argue this too. We don't find that there's an increased probability of takeovers. So that again suggests that maybe these shocks didn't do what people seem to think they did. And many of the results, unfortunately, might be type 1 errors. Again, I also want to, I don't want it to sound like we're picking on individual researchers. I think there's a lot of great researchers who have looked at these settings. And I also think it's likely that there are a high number of type 1 errors outside of natural experiments. But I do want to kind of caution the reuse of these experiments. If you don't account for how many times they've been used, you may get a large number of type 1 errors. Okay, the last thing I want to do is provide some prescriptive evidence, but maybe I'll pause again real quickly and see if there are any questions.
All right, there are some questions remaining from the previous, so to speak, intermission. So it seems like the causal chain should be tested by theoretical mechanism rather than links in causal chain. We may think that the reduction in takeover probabilities could be theoretically linked to investment and capital rising for different reasons and have different subsequent implications, even though they may be in the same place in their respective causal chains.
Yeah, I mean, so I think this is again where on the causal chain argument, there is necessarily some subjectivity. So I think reasonable people could disagree about the ordering and how we should actually implement that. I still like that approach just because it tries to bring in some economic knowledge into how we actually do this. But the challenge, of course, is some people might say the causal chain looks like this, and some people might say the causal chain looks differently. And I think that's true. When I've presented that before, there are some skeptics have kind of said to me, well, you can write a theory that says anything. So I don't like using that theory. to motivate this. But I actually still like that. I think it at least imposes a little bit more discipline on how we do this. But again, yeah, you could argue about different ways to order it. That's certainly true.
I guess related to this point, if the first order effects in the causal chain are rejected, should we even bother with the second order and beyond effects?
Again, I want to be careful about making statements that are too strong. I don't think the first order effects have to be there for an experiment to be used, but it makes it much more challenging for the researcher to support what they're doing. So for example, if you're looking at regulation SHO, you might argue that it didn't change short selling, but some people were worried it was going to change short selling, and so they changed their behavior. So that's possible. So you could actually get a situation where the experiment mattered, even though it didn't have the first order effect. But then I would argue that, again, the burden is on the researcher to provide some sort of evidence to support that claim. They need to show me evidence of a first stage. They need to show me that researchers were actually worried. Sorry, not researchers, that people were actually worried about the change in short selling behavior.
All right, thank you.
Okay. All right, so then I think I'm almost out of time. So the last thing I want to do is provide a little bit of kind of positive takeaways for things that I think we should all do when we reuse natural experiments. And again, I don't want to sound like I'm saying we shouldn't ever reuse a natural experiment. I just want to say we should be a little bit more careful in how we're actually making the inferences. So what we're going to do is we're going to use some simulation evidence to try to come up with adjusted critical values that researchers could use even if they don't want to go through the full exercise of trying to replicate every existing paper and do the bootstrap procedure. Okay, so how are we going to do this? What we're going to do is we're going to simulate 3 popular econometric techniques. So we're going to look at Diff-in-Diffs, we're going to look at instrumental variables, we're going to look at regression discontinuity designs. Within the Diff-in-Diff, we're actually going to look at 2 kind of subvariations. So if you guys kind of look at what we just talked about, Reg Show was really kind of organized as an RCT in that there was random assignment on one date, and then we just saw what happened. On the other hand, kind of the business combination laws have staggered treatment over time. So we're going to actually look at 2 different Diff-in-Diffs, one where the variation all occurs at once, and one where the variation is actually staggered across time. And the reason why we're looking at all these different settings and econometric techniques is we want to see whether or not different settings, different econometric techniques would have different critical values that you'd need in order to make inference, conditional on the number of papers that are already out there. So how are we going to do this? Well, for a given setting, say business combination laws, we are going to simulate an exogenous shock. Then what we're going to do is we're going to take those same 293 Crispin compustat variables that we used in that last subsection. And the reason we're going to do this, I think, is really important. The Romano and Wolf procedures account for the dependence of the data. So in order to actually come up with critical values, we need data that has dependence similar to what researchers are actually going to use. So instead of trying to just make up data, we're going to use real world data that we all use every day so that we have actually real world dependence in there. Now, one thing I want to point out, our right-hand side, our shocks, are going to be simulated, and they are going to be simulated using random number generators. So basically, by definition, these guys are placebos. If we find something statistically significant, it's a positive type 1 error, okay? So then let me give you an example of one of these different settings. I'm not going to go through them all just in the interest of time, but let's take state level shocks. So how do we do this? Well, we're going to run difference and difference regressions. The left-hand side, the dependent variable, is going to be those 293 dependent variables from Crispin compustat. So these are actual variables so that we have real-world dependence. The treatment variable, though, is going to be simulated. And so what we'll do is really simple. We're going to take a random number generator, and it is going to turn on for different states on different dates. So basically, over time, we're going to get this staggered introduction of treatment. Completely simulated, so it should have no actual relation to the outcome variables, and that's what I mean by it being a placebo. Then we're going to run all these Diff-in-Diffs. We're going to then do this a bunch of times, and we're going to build up a distribution to figure out what should be the correct critical values in order to make correct inferences in the data. And here's what you end up getting for the different shocks. Before we actually did this exercise, the reason why we picked all these different settings, regression discontinuities, diff-in-diffs, et cetera, was we weren't actually sure if different properties in the shocks would actually affect the critical values you get. The good news actually is it turns out, regardless of what dependent variables you choose, so we go through that 293 a bunch of different times, regardless of the actual nature of the shock, whether it's a diff-in-diff or an RDD, what you find is that the critical values that come out of this thing end up to be, more or less the same. So once you get to 20 existing results in the literature, the critical value looks like something like 3. If you're down here with 5 results in the existing literature, the critical value is about 2.5. So we're going to have this table in the newest version of the paper. Again, my hope is that people actually don't take the critical values and just say, hey, our results are better than this, so it's true. We should still have some nuanced discussion of how we make inferences. I also think if you can, you should try to actually replicate the existing papers and apply Romano and Wolff. And our goal is to really provide, we have in the paper, step-by-step instructions on how to do that. But if you can't replicate everything, hopefully this table is helpful. Okay, so lastly then, let me provide a little bit more in the way of recommendations. So what we're arguing here is that this multiple testing issue is particularly severe in the natural experiment setting, just because some of these experiments are being used over and over and over again. So we've given you a couple of different recommendations for how to implement that. Publication date, causal chain, pooled. Again, you guys have already hit upon a lot of this. There are trade-offs involved with these different choices. And so, you can make an argument for different ways of implementing them. The good news is at least in our experience, more or less get the same inferences in the end. So the inferences tend to be pretty robust to what you actually do. But then I also want to caution and say that we shouldn't live in a cult where if p-values or t-stats are a certain value, we say, hey, I have a result. And if they're not, we say, hey, I don't have a result. Our job really as economists is to make inferences, and p-values and t-stats are kind of one input we can use in our inference, but we should think about a bunch of other things. So one, really do step back. If you're going to reuse a setting, make sure that you have evidence of the first stage. What I'm amazed about is in a lot of these natural experiments, people have kind of just skipped ahead and they look at third order effects without actually looking at the first order effect. So some of the papers out there argue that the first stage for business combination laws and regulation SHO is not there. There's not a result. And so that makes it harder then to think about all these other follow-on stories that people are kind of talking about. And again, I think that plus the results we present suggest many of these results, unfortunately, are probably type 1 errors. Second, think about the causal chain. And in fact, Pearl has done this really amazing job building out this entire literature of thinking about causal chains. But you want to think through the mechanisms through which your stories happen. And make sure they make sense. Moreover, if you are the 18th paper to use a setting, you have an obligation to talk about your exclusion restriction in light of all the 17 other papers that were out there. You can't just pretend you're the first paper and talk about the exclusion restriction as though we don't know about those other results. We already do. So I think you do have to reconcile your findings with the previous published results if you're going to reuse a setting. So again, I'm not saying never reuse a setting. I think you can reuse a setting. I'm just kind of cautioning and saying we should step back and try to make some inferences carefully when we reuse the setting. And here are some kind of guidelines and things that I think we should all do. Okay, with that, let me conclude, and then I will take some more questions. So at a high level, again, kind of what we're arguing is we've had this amazing credibility revolution, but we're arguing that we're using natural experiments without really thinking about exactly what you're doing is undermining that exact credibility revolution. As a result, I think we have a huge number of papers that are documenting results that are just type 1 errors. So we're advocating the use of the Romano and Wolff method to correct p-values. We gave you a bunch of different ways to do that. The results more or less are robust to those choices. Moreover, then we provide critical values so that you can actually make inferences even if you can't apply Romano and Wolff directly. But again, my preference would be we should all try to apply Romano and Wolff correctly. Okay, so with that, I think I have a few minutes for questions. And thank you all again for your time.
Thank you, Matt. Okay, let me read some of the questions that remain in this, the kind of a comment, I guess. This is why we need to allow publication of similar findings. The initial RegSHO, a pilot, had at least 3 publications that confirmed the Dieter et al. Findings.
Yeah, I mean,
Um,
I love this comment. I actually think, I mean, we all say this, but I think we can all work to make it true. Instead of everyone chasing a new finding, we should be really happy when people confirm existing findings. Moreover, I also think it's really important that we publish non-results. So I think it seems like lots of people say they like the idea of non-results and then they reject them when they're the referee. But I think we should like non-results. Non-results can be incredibly informative, and they should appear in journals more than they do.
and this is, again, another comment. This is why we need a repository of insignificant findings and methods to basically address the issues of kind of statistical errors that we have here.
I mean, I agree with that, but I also think if we think journals are an important way to disseminate information, we could have a whole separate conversation about that, then journals should be some of the ones that are publishing these non-results. They should be helping categorize and create a record of non-results.
Right, let me see whether we had any more. Well, it seems like we have exhausted our list of, oh, here's, as I'm about to close, we have another question. So why shouldn't we make it a standard practice to use all the 293 for the right, for RW correction, or Mann-Wolf correction? That eliminates the potential land grab use.
I mean, it does, but again, I kind of view this as there's always trade-offs, and that kind of goes to one extreme. I think that question depends on what you think is worse, type 1 errors or type 2 errors. And I think we could have a very long debate about that. And it's not always clear whether type 1 errors are worse or type 2 errors are worse. If we use too many variables in the Romano and Wolf corrections or in any multiple testing correction, then what happens is you might increase the rate of type 2 errors. So there's a careful balance between these things. I think in most cases, if you just apply the correction to the papers that are out there, it improves inference quite a bit without blowing up the type 2 error rate. But I think it's certainly an interesting question. And I think we as a profession should think about these issues more.
All right, so with that, let me wrap up this presentation and the Q&A session. Thank you very much, Matt, for very insightful and very informative presentation. With that, I would like to kind of conclude today's seminar. As a reminder, next week we have Adi Sundaram from Harvard